Hi, and welcome back to Mike on Money. My name is Michael LeBlanc, Senior Portfolio Manager with LLC Private Wealth at CG Wealth Management. And today on Monthly Market Mistakes, we're going to be talking about principal protected notes or link notes. These notes have become more and more popular over the past few years as markets have continued to provide some pretty solid returns for investors, and they're looking for higher returns from their fixed income investments, and they started to lean on these principal protected notes more and more in the recent years for sure. So since people have been see these as safe investments, let's take a deeper dive into how they work, better understand them, and why you might want to consider alternatives. So let's jump right into it. And before we get started, these notes come in all kinds of shapes and sizes and flavors. So we're going to be talking about some of the main characteristics, some of the main features, to give you a sense of the different risk, potential opportunities, and whether and how you might want to use them in your portfolio. So what is a principal protected note? Well, they're structured investment products issued by financial institutions. Here in Canada, mainly the big banks issue them. They're typically market-linked note deposits or notes that combine the features of a fixed income security, like a GIC, with principal protection, with exposure to the performance of an underlying asset, such as an equity or equities. It could be a basket of equities, indices, or even interest rates, a variation on interest rates. They're generally sold in $1,000 denominations, and they're linked to that underlying index for their performance. And that index dictates how much you will earn over the lifetime of the note. Linked notes can be anything from a stock index like the TSX or S&P. It can be an individual security like Royal Bank or TELUS, or it could even be a combination or a portfolio of securities like Canadian financials, maybe the top five banks or maybe the top five oil and gas companies in Canada as a basket of equities. Some of the key features to keep in mind, they do have maturity dates. They have a fixed term that you generally have to hold them for. Yeah, again, there are different features to this, but in general, they have a fixed term, and it can range from 2 years to 7 years. The most common is around 5 years. Now, you must hold the note to maturity to realize the principal protection or and any market-linked returns or gains. Again, we will talk a little bit about a couple of variations on that, but again, the main characteristics, you have to hold completely to maturity to get your principal back and your gains. So the principal protection part of it, well, basically at maturity, 100% of your original principal that you put in is guaranteed by the issuer or the bank in general. So regardless of market performance, you get your money back. So even if it's at negative, you will receive the initial amount that you put in, assuming there's been no credit event at the issuing bank. But that's not a huge concern that a Canadian bank is going to go bankrupt. But generally, you have the bank's guarantee that they'll return your money. Now, unlike stocks or mutual funds, you will not lose your original investment at maturity if you hold it to the end of that term. Now, this is not true in all cases, which we'll discuss a bit more in a moment. The market linked or the returns that you're trying to get, the potential return is tied, as we mentioned, to that performance of the underlying index or basket of indexes or equities. Do keep in mind your return only includes capital appreciation of that linked strategy. Any dividends that are paid by those equities are not included in your return or in the formula to calculate your returns. Again, you might find some within an exception to that rule, but generally you don't receive dividends as part of your gain. So depending on what you're linking to, that could be a big part of not only your downside protection, but also your returns. Now, returns may be capped, so a maximum return, or structured, like a partial participation or average in formulas, or there might be a conditions to the payout. They might have something called the call feature. So this is popular, actually, the call features, certainly in the last couple of years. And that's basically if your note should hit a certain return, let's say 8%, prior to maturity and during a stated period of time. So it might say in the first 12 months of the note or the first 6 months of the note, if the underlying index is up, say 8%, your note will be called back. So it means you'll receive that fixed rate of 8%, or whatever the promise is, and your principal back early. So that's, gives you liquidity prior to your maturity date, which can often be seen as favorable, but you do get capped. If your underlying index is up 10% or 15%, you're capped at the 8%, and now you have liquidity. So another thing to keep in mind, tax treatment of these things, your returns are generally taxed as interest income, not capital gains or dividends. So even if it's linked to an equity or an equity index, it's still or taxed as interest. So that can really reduce your after-tax returns if it's in a taxable account. Obviously, if it's in a TFSA or an RSP, that's not an issue for you. But if it's in a taxable account, do keep in mind you're going to be paying full tax up to 50 plus percent, depending on what province you're in, on your returns there. The issuer guaranteed, as I mentioned, is based on the credit worthiness of who's issuing the notes. And again, it's generally banks, but unlike GICs or bank deposits, they do not have CDIC insurance. So they're not insured if something should happen at the bank. Now, one of the big risks you need to consider is liquidity risk. As I mentioned, you generally don't get your money back to maturity. A lot of these notes, issuers will advertise a secondary market for these notes, but keep in mind, this is not a trade-in market. This is a market maintained by the issuer, so by the bank that's issuing them, and it's very limited. It provides fairly discounted options. So basically, if you want to get out early, there may be penalties built in or a big discount that they're going to buy it back from you at. Even if that note happens to be in the money or up at the time, you probably won't realize any of those gains. You would actually likely take a pretty big loss. They're not liquid like a stock or an ETF. So you're pretty much locked in until maturity on these things. The other risk is opportunity cost. As I mentioned, you might be capped on your returns, or you might be reduced in your returns by a participation formula. Or if you get called out early, it's going to limit your upside. And if it's if you've picked the link or the index well, in a strong market, yeah, you might find yourself earning a lot less than if you had the direct equities. And you also don't have that liquidity to exit when you want. So should your outlook for that underlying index or underlying equity change during your term, say 5 years, you can't exit from it and take your profits halfway through. You're stuck till the end. And that can really change your return. And keep in mind, if you do, if the principal protection actually comes through for you, and at the end of the 5 years, your index is negative, and you're like, okay, great, I get all my money back, all my principal back. Well, you've gone 5 years with a negative or a flat return, right? You've made no money over that period on that capital, which isn't great. You always hear about loss of money to inflation or loss of opportunity cost. And really, what are you getting in return for that principal protection is that 5-year gain. But really, take a deep dive into what the index or equity or what you're linking to, because most markets historically over 5-year periods, generally haven't historically given a negative return over that longer period of time. They might have at different periods during that 5 years, but generally over a 5 years or longer period, it's been positive. Again, that will really depend on the equity or link that you're looking at, but do that investigation to better understand what you're getting in return for that guarantee. The other thing to be very cautious about is complexity or transparency of these formulas to better understand how you're getting paid. A lot of them can be hard to calculate, to understand, to stay on top of, to see, where you actually are or how you're actually doing. It's not something they publish on your statements, so you wouldn't necessarily know, if you're in the money on them or how much you're in the money on them. And the more complex or vague or harder it is to really get the details, I would caution more and more around those, because if you don't understand what you're buying or why, I would probably stay away, because a lot of these can have complicated formulas or an averaging cost period or averaging gain period, and those caps or participation rates, where you'd only participate in partial gains. And remember, it's not that easy because you're not getting the dividend benefits either. So now let's talk about that downside guarantee. As I mentioned earlier, PPNs have that principal protected status, which is great. If what you invested in goes negative, you get your money back. Now, here's where that risk comes through, though, as we've been talking about, is that illiquidity. Remember, these manufacturers will often advertise that secondary market to sell your notes after they're issued, but you're taking that big discount. They're buying it back, right? They're buying it back into their own books, or they're dissolving it when they buy it back. It's not a secondary market that you're selling to another investors. Now, the other big feature to look for, because this has become a lot more popular with principal protected notes, is they're not all 100% principal protected. A lot of them common things we see these days will have a protection threshold. And a very common one is about a 30% downside protection. So in these scenarios, is if you're basically protected as long as that underlying index doesn't break through that barrier. So if your linked index were to drop 29% while you've held the note, at the end of your hold period, you'll get any potential gain at the 5-year mark and your principal back. However, if at any point during the term of that note, your index were to break that threshold, or that 30%, go down 30.1% or 30.5%, your protection is gone. And at the end of the 5 years now, you are going to take the full hit of any negative returns off of your principal at maturity. It doesn't give you early liquidity. It doesn't let you get out. You're just going to take the full downside hit, just like if you owned the underlying security itself. So basically, you'd be taking all the risk and giving up the dividend payments if they were to come into play, but not obviously not getting the ability to get out earlier if needed. I will footnote here, there are a lot of built-in fees in these products that can be a big concern as well, but this would be a case-by-case scenario. So I don't want to make a blanket statement about, fees are too high, but it is something to take a deep dive into, because of course, the higher the fees, the higher the threshold is for you to make money upon exit on these things. It will carve into your participation amounts. So why do people buy linked notes when the markets are hot? And well, as I mentioned, they're an attractive way to replace your fixed income. It gives you a sense of protection in the portfolio. Should the equity markets go down, you have that floor, or that maybe that 30% protection or 100% protection if that's the ones you go for. But I would say that that illiquidity factor is pretty costly to not be guaranteed any return at the end. If you had a base guaranteed return like a GIC, at least you know what you're going to make over that period of time. It's going to be lower, but at least you know what you're going to make. Whereas in this scenario, you won't know till the end, and it could be zero or less. The other thing people quite like is, unlike equities, they tend to not show volatility in your portfolio. So they will continue to show their face value, potentially giving you some peace of mind, even though that part of your portfolio isn't really performing for you. So that guarantees the main reason people go for them. But do be careful that trade-off, the lack of liquidity. Now, as I mentioned at the beginning, there's so many different variations on linked notes or PPNs. It's impossible to talk about them all in one video. And I'm not saying they're all bad and should be never used. I, you know, you just really need to do your research, fully understand what you're buying. Does it fit in your portfolio? And like any investment, it is important to understand how it's going to fit in and what are the risks associated with it. And if the amount you're exposed to fits into your strategy, especially with these illiquid investments. As we've discussed in our previous videos, don't overexpose your portfolio to linked notes or any other liquid products in there. And really understand what your up and downside risk are on these things, because when you're dealing with anything illiquid, you're trapped, right? There's no getting out or changing mind, not without taking a big hit. As always, though, if you have any questions about any products you currently own, you're thinking of buying, reach out to us. Email us, phone, go to mikeonmoney.com. All our contact information is there. Obviously, it's down below. But really do your research or ask us the questions. We're happy to look into any ones that you're considering. They do have a lot of different structures I haven't even touched on here on how they create that guaranteed amount and the return side of things. They're not actually buying those underlying indexers or equities. They're using derivatives. So that's another important aspect to really understand, because if it's going to unwind or go awry on you, you need to know what structure they've used and what the risks are around that. So reach out to us. Happy to go through that with you or answer your questions. But until next month, I'm Michael LeBlanc. This is Mike on Money, and thank you for watching.